The basic group term life is when EE dies. When EE dies, then that amount goes to the beneficiary. We have disability provisions, WOP, total and permanent disability installments, where the death benefit. You can actually get that, and you take that from the DB, and that gets placed into the disability installments. And we have an extended death benefit, so let's say termination, but then they die within a year. Well, that still carries over with if it was still within that year. The beneficiary has to be non-employer. Group supplemental is then you have this group term life, but then what if EE wants their own additional, and so that's why you have group supplemental. And that is suicide exclusion, only WOP disability provision, and it can, if it passes the straddle test, meaning if the rates are all above or all below the table one rates, then we know that there's no direct or indirect employer subsidy. And when there's no direct or indirect employer subsidy, then it's all paid by the EE. And if it's all paid by the EE, then that's not considered to be taxable. Dependent group life is lump sum to EE if dependent of EE is dies. Survival income, that's a monthly stream. So it's not a one-time lump sum, but it's a monthly stream to beneficiaries upon death instead of just a lump sum. And it's typically a percentage of EE earnings. It's an annuity stream. And we have group permanent, which consists of single premium. That's just one forever for life EE. We have group ordinary. There's this cash value that grows. But how is it different from group universal permanent life? Is that group universal permanent life, you can have an increasing DB. You can also have a changing premium. But here with group permanent, group ordinary, it's a level premium and the DB is fixed. So cash value grows. So the premium, it's some of it is goes to paying for the insurance protection. Some of it goes to uh, a separate cash value fund, and that cash value then does increase. Okay? And we have group term and paid up, which is at the beginning. We have some of it is being paid up by the EE, some of it is being paid by the ER, and then as time progresses, eventually you get to a point where the EE has fully paid up the entire policy. And then they can, after termination, then they can fully consider that to be theirs. Group variable universal permanent life is the same thing as group universal permanent life, except except you can have multiple investment options in the cash value fund. There's no rate table for Canada, so you just take the average. We know HMO, PPO, POS. We know HMO. We have must-use doctors, hospitals, providers that are in network. We have a PCP coordinates care. We have referral from PCP to an or go to a specialist. No coverage outside. Low premiums, low cost sharing. Must follow plan rules and network. Very, very, very coordinated. Very strict in regards to what type of providers and doctors you can use. Must use a network. PPO, we know, can you see any doctor specialist you want, but prefer to be in network, but you can go OON. And if you do, obviously the cost will be higher. POS is a hybrid, and yeah, you must choose a PCP. We know dental plans are standalone. EE contributions are pre-tax. Helps EE have stable budgets. And we know we have one is preventative diagnostic. They want you to do these in order to make sure that in the future, further down the line, you don't develop a more severe dental condition such that it does actually severely raise the cost. Two, we know is basic root canals, extractions, anesthesia. Three, major inlays, crowns, bridges, dentures. Waiting period. So this waiting period is essential because you don't want people to be just as soon as they get dental coverage to immediately use their services, and then you have increasingly high costs within the first 2-3 months. So we have this 6 month waiting period for, let's say, class 3 services. We have these frequency limitations, say you can't use this service more than X amount of times. There, this pre-existing condition, someone already had, let's say, a missing tooth, and then they just got dental coverage and they want to immediately repair that. So we have this pre-existing condition limitation, least expensive alternate treatment. So these are the possible treatments that this dentist is offering you, but we know you can get this other treatment that's cheaper. And so you have this least expensive alternative. We have exclusions, benefits after insurance. And we have indemnity, can visit any dentist, highest cost share, no need to have PCP, no need to have PCP. This is UCR, PPO is also UCR, and there's some fee scheduling there. The fee scheduling is there in PPO. We have HMOs, typically capitation, the least flexible. We know there's this network discount and optional out of network coverage. Future dental plans, we know oral health linked to overall health. Plans differentiating unique added benefits, prescription drug costs. So we have this drug pipeline. So we have from research phase, then we have research and discovery phase where then we have the brand patent protection to ensure that the manufacturer is the only one who can produce that drug. Then we have the generic exclusivity period where only one other manufacturer can actually produce the drug, and then we have the generic drug lifespan period where everyone and all other manufacturers, more than one, can produce this drug. We have specialty drugs, high cost, lower util biologics made from living organisms, direct to consumer advertising. So they do these advertisements, and maybe they want this medication from then they go to their doctor and then request this medication. So we have manufacturers, they produce the drug. Wholesalers, they are the ones who get the drug from the manufacturers, and then they distribute those to the pharmacies. Pharmacies can also get those directly from the manufacturers. PBMs are the middlemen that could take control of all of the plan admins and costs, and they determine, is this drug covered? They develop formularies and place the different drugs of the manufacturers on different formulary tiers, determine cost sharing, ensure that these claims are covered, ensure this drug is covered. And they also have negotiations with the manufacturers in terms of rebates to place their drugs on preferred tiers. We have third-party payers, so these are your ERs or your insurers. You have your beneficiaries, those who actually get the drugs. And we have the healthcare providers, those who actually make the treatment and recommend it to get this drug in the first place. Generic drug, we know we have a brand drug. This is the only available drug in the market. We have a generic drug, which is a copy of that drug made by a different manufacturer of specialty drugs. Again, high cost, low util, high cost, low util. Also with biologics, compounded. They mix these chemicals, and it's typically made at the pharmacy over the counter, as you don't need a prescription. Research development, brand patent, generic exclusivity, and then generic drug lifespan. Retail pharmacy, 1 month supply, mail order, yeah, you can have 3 months. And then we also have specialty where the specific storage is. And we have closed, open, and tiered. One is most preferred, generic brand, generic preferred, non-preferred, generic preferred, non-preferred. Brand specialty then can also be broken out into preferred and non-preferred. Value-based is that they can specifically note this as this is a value based. This is a high value drug, meaning don't aka dispense is written. Don't take the generic. We need this actual brand. These typically have lower cost share. They're high value. So what they do is they want to make sure that you take this, so you don't take an alternate drug that may prolong treatment. A quantity limit, number of refills, prior auth. So the PBM then gets this prescription, and then they may request lab diagnosis tests to actually make sure that the medication is actually needed. Then we have step therapy. You must try one or more lower cost drugs first before you get this one. And then we have primary models for PBMs to contact third-party payers. So we have transparent and traditional. Transparent is now the PBM passes all that. So what happens is sometimes a PBM says, okay, we didn't. They pay the pharmacy one amount, and then they communicate something else to the third-party payer. Here in transparent, they're being extremely clear that, hey, this is what the actual drug cost was, this is what the rebates were, this is what we paid the pharmacies. So being very explicitly clear about their admin service fees. Traditional lock-in pricing is you mark up these drug prices, and there's less pricing transparency. So you may give something to the pharmacy, you may take something in as profit, you may display something as a number just directly to the third-party payer without actually detailing where the breakdown of what that single number actually comes from. So there's less transparency there. We have legal issues with PBM, so that's why manufacturers generally don't own PBMs to avoid conflict of interest, or else they will just make their drug on tier one preferred. PBMs and pharmacies are always consolidating. Third-party payers should understand these formulary decisions. They have a right to. They have a right to. Steps of product development life cycle. Innovate, so strategic perspective, idea generation. We want to try to understand what the different ideas are in the market. Are there any consumer demands, marketing, sales demands, leveraging and competitive advantage, social need? Is there any technological advancements that we can see come through that may spur an idea? We have these regulatory compliances, product structure, benefits, contribution requirements. We build the product. So pricing, we project enrollment. And then after we project enrollment, price the product, then we need approval. And then we sort of implement the infrastructure of the product, the actual implementation of it. And then we do the financial assessment. So pricing, projecting, then need to get the approval, and then you actually implement it. And then think about what the structure for implementing it is. How is this going to be sold? What's the entire data processing going to look like? What's the entire flow of the consumers receiving care? So that's the building of the infrastructure. Selling it now, there's a test market, then you market it, focus groups, payments, let's take a survey, and then after you do it on the test market, then you have the mass marketing. And then you assess, so you track financials, what's the actual to expected, there's some customer feedback, and then you continuously monitor these sales. Senior management, marketing, sales, underwriter, IT, HR, legal and compliance, finance, actuarial are all teams, right? Actuarial, projection, finance, projection, compliance, legal, operations, making sure everything flows smoothly, IT in terms of data processing, underwriters, again, actuarial science, finance, projection, sales, marketing, again, to actually sell the product, senior management for approval during the design and the innovate and the build phase. Considerations for rate making. You want to look at market conditions, what existing products are there, your own strategy and profit goals, and what's the regulation. Density functions, we use those for HDHPs. We use those when we have annual maxes, summarize annual max on a per month basis. Cost buildup is we have these individual pieces that we're doing to sum up together. So that's why we have copays. And it's typically like in out network stuff. We have expenses, different type of expenses, commissions, advertising, brokers, bonuses. Two ways is activity-based allocation, functional expense allocation, group life plan characteristics, and there's some min participation level, right? Or otherwise you can have anti-selection. There's a waiting period. Sometimes there's no need for insurability. And how do we develop expected mortality costs? SOA studies. We have company-owned experience, population statistics, actual expected ratios. Now, when do we have these accelerated death benefits where you have this DB, but then you get some portion of the DB before the terminal illness, catastrophic illness, long-term care? Sources of internal data. We have medical claim systems. We have PBM. We have the premium billing information. Also, we have provider contact information. So provider contact, they have information on the consumers. Right, premium billing is whenever you pay the premium and eligibility data, you have to submit the data. For that PBM, again, responsible for upholding the plan information and communicating the plan information and checking if things are covered in the plan or not. Data collection process, normalizing data for rating variables, data considerations, pharmacy data consideration. It's collected electronically and it's a lot more accurate and complete because there's no completion factor. It's like a fixed amount. There's no delay or lag. It's processed at the point of sale compared to medical claims where you have a delay period, you have a reporting period. It could be incurred but not reported. So it's a much shorter lag, much faster. It's automatic. Data fields, we have national drug code, we have day, units, supply, allowed amount, refill indicators, name, tier, gender, fill date, claim ID, ingredient cost. So we take the AWP average wholesale price, discount, 1 minus discount, and then the allowed amount. This is the thing that gets trended. It's ingredient cost plus all the fees, vaccine sales, tax fees, and then expected claim liability, allowed amount minus cost sharing and rebates, and all percentage of the allowed amount. Rating factors, demographics, formulary design, and then management programs, we have prior auth, step theory, quantity limit, where we already have gone through these brand patent expirations. So now we can finally create this generic, and then now this goes from it moves in the formulary tier type. Contracting, discounting, dispensing fees, nominal versus effective copay. Effective copay is what the member is actually paying. Nominal is what is listed what they should pay, but they're not going to pay the actual if it's less than that. Pricing consideration, credibility, fixed cost leveraging, so the plan liability increase faster than allowed costs if the cost sharing stays the same, because if the cost sharing stays the same, but then we have the actual allowed cost increase, well now that since the cost sharing stayed the same, the percentage cost of the insurer increases faster than the total cost increase, and dampening has the opposite effect. That's fixed cost leveraging. So essentially what we're saying is that what the ER is responsible for paying, that increases faster in terms of the percentage, than the growth of the allowed. Credibility, integrated plans, timing, and rebates. Then we have goals of why do we need this formula design? Well, it's for adequate coverage, making sure all the drugs needed are covered. Marketability, want to make sure that these drugs that these manufacturers are producing are actually being delivered to the consumers, and they can only be delivered to the consumers if they're actually covered by the plan or not. And so that determines marketability, and also some sort of cost control. They're all easy to get. If we have no hierarchy, then we have no way of communicating the preference of what we want consumers to actually get. We have FS, reasonable, customary, dental PPO. Balance billing is not allowed in dental PPO. And we have pre-auth, pricing trends, core cost, core util, one-time changes, population, structural, alternate payment methods, capitation. So one time is like COVID, right? Population changes, structural changes. We have startup, catch up, steady, rush, crush, rush to using benefits before they become less generous. And everyone has already received this type of care. So now util temporary pause because nothing else is more to receive. Usage then returns to normal. 12 is risk classification. Things to note here: equitable, fair rates, justifiable. Need to make sure that can these patterns long term hold up? What is the intended usage of these risk classes? And if you're departing from any of the industry standards or outliers, you want to make sure you communicate that. Make sure that they're reasonable. And data quality, we know we have selection, review, usage. So selection, what's the cost of attaining other data? What's the benefit? What's the use case? Is it consistent with the other data sources? What's the reasonability? Data review, reasonability, outliers, limitations, consistency with prior analysis, data definition. So you're looking at, okay, definitions, outliers, what am I going to use this for? Reasonability, is it consistent with previous things, external sources, questionable values, so outliers. Now using it, as you're using it, is this of sufficient quality? Am I getting the most out of this? Are there any defects or actions that are needed? We have credibility, so that's ASAP 25, and it must whatever you're blending against, that must have the same frequency, similar frequency and severity, and other similar characteristics. Because if it's different, then why are you even blending those two? Homogeneity, right? It has representative segments of the data, actual communications, right? Within a report, you want to make sure you're communicating uncertainty, risk. If there's any conflict of interest, or you relied on other sources, is there if you have different parties making up a assumption, you want to make sure different parts of that assumption, which each of those parties were responsible for. Any disclosures and any actual communication, so limitations, findings, acknowledgement, scope, conflict of interest, risk and uncertainty, information date, subsequent events, documents. So you want to disclose things about risk, uncertainty, your qualification, what's the intended use case, limitations, if it deviates from anything, conflict of interest. And to reduce effects of random variation, catastrophic claim pooling. So you add the remaining charges evenly to other groups. Credibility weighting, weight the incurred claims, afford premium and the expected incurred claims. We have these benefit changes, mortality trends, government program changes, economic changes. Retrospective, you take the prior, add premium investment earnings, incurred charges, remove those, remove risk charge. Fully insured, insured bears risk, subject to state insurance laws, premium tax owed. We have min premium contacts, these typically don't get tested that much. Self-insured, complete control of all overall premiums, so they have complete control. It's typically for larger ERs, they do have to pay to manage their plan. They have to get some external advice. Claims volatility and financial responsibility are both favorable and unfavorable. You have to take into account timing, claim payments, diagnosis, hospital contracts, internal processes, which is more complex. Level funding, again, it consists of IBNR, ASO fee, stop loss, specific stop loss, paid claims fund. Small group traditional level funding, because level funding, they don't have to abide by ACA. They do have to pay some ACA fees, but not all ACA fees. We have regulations, so we have essential health benefits. ER must provide essential coverage and benefits to the EEs. And if not, then there are consequences, and those consequences are listed under 4980 HA, which they must provide at least min essential coverage to at least 95% of FTE. If one EE enrolls in the exchange, receives subsidy. The penalty of at least 2,000 for each EE. So 2,000 times FTE minus 30. But even if they do offer that much, if it doesn't meet min actual value, then penalty is 3,000 times number one roll of the exchange and receive subsidy. We have private public exchange. Private exchanges are run by private companies, insurance companies. You go to this website, and the benefit is that they do have these technological platforms where they're able to easily display the different options and the benefits of each option, and very allowable rating variables. Proposal character considerations. We have these performance guarantees. So proposal consideration is submitting a quote, hey, we need this insurance product, and submitting it back. E-choice, inertia, availability, or actions. Multiple options. You have this favorable selection, satisfaction. You have consumerism is good, and then you have contribution concept. Can implement. HRA, risk assessment classification scheme, demographics, lifestyle, behavior factors, measurement. And let's see, steps. We have risk assessment and then payment adjustment. And then need, why do we even need it? Well, we have this ACA risk adjustment program, and we want to do equitable payments to insurance and providers to make sure that they're competing on not the health of the consumer that they get, but actually quality and efficiency of care. So that's why when we also have these multiple choice situations, make sure to limit spread and benefits so you don't get anti-selection. Favorable cost sharing among the options, limit the spread in E contributions. Limit options with selection potential. Participation requirements, add those. And we have COB, we have TRA, leveraging effect, top spenders. And then we have, why do we need functional approach, comp philosophy, functional approach, responsibility of benefits director, delivery, policy formulation, compliance, E contributions. How do we determine those? Well, it's a defined benefit or a defined contribution. These are the levers. And we'll stop there.